Hey, Daniel Clayman here, and I've got a pretty quick case study and tutorial for you on how to analyze an apartment building quickly and accurately. And in this particular case, we're going to talk about an 8-unit apartment building that I saw a couple of days ago listed on LoopNet, and as you'll see shortly, there are no good deals on LoopNet, but we're going to use this apartment building as a case study, and even more specifically, we're going to talk about how to do BRRRR analysis for an apartment building. So why BRRRR analysis? If you're not familiar, BRRRR basically stands for buy, rehab, rent, refi, repeat. This is a strategy that I've been using and teaching since 2008, and it's a strategy that has allowed me to accumulate a pretty sizable real estate portfolio of rental properties. And so why are we going to specifically look at BRRRR for this apartment building? Well, again, as I'll show you in a second, buying at 6.5% cap rate is not how you make money in real estate. Only people that need to put away large chunks of cash into safe assets for the long term can invest in assets at 6.5% cap rate. There's just no cash flow there. There's not enough of a return. So let me show you quickly. This is the listing, right? This is the listing on LoopNet. It's actually a pretty solid brick apartment building in a very, very good location. This is a great location, but it's 8 units offered at $995,000. But given the current rents, it's a 6.5% cap rate, which means that if you were to buy it cash, right, that basically just means your cash and cash return would be 6.5%, which is not very attractive. So, and there might be room to raise rents as is, but probably not that much. So the play here, and I mean, they even say it in the listing, right? It's a value add opportunity. So the play here, the way you can potentially make money here is by improving the apartment building, raising the rents, and thus by raising the rents, you increase the value of the building, right? These are 8 2-bedroom units. They're averaging 960 square feet. So 960 square feet for a 2-bedroom unit in and of itself is kind of tight. You can make it work, but your finishes have to be amazing to get really good rents because these are not big apartments, right? So you can see in the listing, it's got, construction is poured concrete with 8-inch concrete floors. That's nice. Brick exterior, solid building, hardwoods in the units. It's got central heat, but no central air. And rents are currently pretty low. And here's their marketing brochure. If we download that. So this on the face of it is an attractive opportunity, but how do you know whether it's an opportunity you should pull the trigger on? And moreover, how do you know what to offer? That's what I'm going to show you in a second. So let's go back to my fancy slides that I created for you. So buying at 6.5% cap rate, it's not how you make money in real estate. You would have to, if you were to just buy this building as is, you would have to tie up roughly 25% down, and that money would not generate you a very high cash and cash return. So instead, you go in, assuming you can buy it at the right price, you do a value add, you improve the apartments, make them really nice, raise the rents massively, increase the net operating income in the building, and thus you massively raise the value of the building. So with BRRRR, you can pay for improvements, and then you can refinance and pull all or most of your cash out, depending on the numbers in the deal. Again, otherwise you're tying up 25 to 30% down plus the money that you're spending on improvements. So if you can execute a BRRRR strategy on a deal like this successfully, you'll have a great building with minimum cash in and hopefully really good cash flow. And I have much more detailed BRRRR training. There's 2 separate close to hour-long videos on BRRRR training. If you go to rehabvaluator.com/developers. So if you're not familiar with the strategy, after you watch this case study, go back and watch that training. It's absolutely free. So data points we're going to need for accurate analysis. First of all, we need to know what upgrades to make and approximately what they're going to cost. Don't stress about knowing exactly what your improvements will cost here. For the sake of this analysis, you just need to be in the ballpark. Market rents you'll be able to charge after the upgrades are done. ballpark operating expenses after upgrades are completed, and then what the short-term financing and then what the permanent financing that we will refi into will look like. All right, so goals for our analysis: determine the max offer we can make in order to, and this is key, leave as little cash as possible in the deal, earn a high enough cash and cash return on any money that we do leave in the deal. And me personally, these days, I need to generate at least a 10 to 12% cash and cash return on any money that I leave tied up in my properties. And we need to create a minimum required amount of sweat equity. And in my case, I look to have at least a 20% sweat equity when my renovation is complete, right? So I need to have 20% equity on paper, and I'll show you how we're computing that as well. So let's jump into Rehab Valuator, and I'll show you how to do this analysis really quickly. All right, so we're going to log in, and it's very important you pay close attention here because we're going to go into the numbers, right? We're going to go, this is fairly simple analysis, but you need to understand how the numbers work. And a lot of what I'm going to show you, you can do with the free version of the software. I'm going to show you some things that you can only do with the premium version of the software. But whether you're watching this and you have the free account with us or you have the premium account, this will massively help you. So we're going to click Start New Deal. And let's just call this 8 unit in Scott's Addition. And I like to, I like to add as much into my notes as possible. Let's leave the address out for now. All of that doesn't really matter as much. So let's do this. You've got a couple of sections on your analysis screen. You've got the purchase assumptions where your purchase price, closing holding costs go. You've got your renovation assumptions here, and you can toggle between construction if we're doing new construction or rehab. In this case, it's rehab. And you've got your short-term financing assumptions, and then you've got 2 exit strategies that you can toggle between whether you're flipping or, in our case, we're going to hold. So this is very important. For this type of analysis, you need to start at the end. And same thing applies to flips. Before you can figure out what to offer for something, you need to know where you're going to end up. What do I mean by that? The first thing that I always do is determine my after repair value. What is this building going to be worth when I'm done renovating? And for apartment buildings, the after repair value depends on the new income that the property will generate after the renovations are done. So the first thing I'm going to do is I'm going to go here, enter projected income. We're going to enter 8 units. I think they're about 935 square feet. And I've done my market research, and you can go to Hotpats, you can go to Zillow, you can go to Craigslist, and a number of different sites, and you can do some market research and figure out if I make really nice renovations to these apartments, what are they going to rent? And so in my case, I'm ballparking roughly $1,300 in rent for these units. And I typically don't even model a vacancy, but when I take this to my bank, they're going to want to see a 5% vacancy here. So you can see that on a monthly basis, after vacancy, my property will generate $9,880. And I'm going to click Update. And now I'm going to go to my projected operating expenses. We charge internally an 8% management fee. I'm going to ballpark my insurance. I can toggle here between total monthly, total annual, and I think total annual insurance for this building, based on my other projects, is probably going to run me about $2,500, right? That's probably on the high side, but when I do these projections, I like to be conservative, right? Monthly landscaping is going to cost me about $100. Real estate taxes, I've done my research. I looked at the assessments. The other issue is when you renovate, your assessment is going to go up. So my annual taxes for this building are going to be roughly, let me get my calculator out, this much in taxes every month. So what other expenses do I have here, right? Repairs and maintenance, this is going to be a fully renovated building, so I'm going to still plug in, let's say, $500 a month in repairs and maintenance. Janitorial, there's going to be some common areas in this building, so I'll plug in also $50 a month in janitorial, and that's it. Now, as far as utilities, currently tenants pay water, sewer, trash, but we like to pass this off to our tenants. So I'm not going to include water, sewer, trash here. What I am going to include is common area electric meters, and that's going to run me about $50. And I'm going to click update. And look, you'll never be 100% correct on this, but you should be in the ballpark. And I usually, as a sanity measure, I look at my operating expenses as a percentage of my income. And if I'm somewhere between 25 and 35%, I'm in the ballpark. So now I know that my monthly net operating income is going to be roughly this much after the renovations are complete and after I've leased the units at their new rents. Now I'm going to ballpark my after repair value in order to make my cap rate. This is very important, right? This is incredibly important. This is how we determine our after repair value. The market cap rate is 6.5%. So I'm going to mess around with this number until we get to roughly 6.5% here. $6.17. So this gets me in the ballpark, right? At $1.2 million after repair value, given my new income, that's going to give me a 6.5 cap rate. So I can confidently go in, and actually I just looked at my calculator. I made one mistake. I was computing my property taxes based off a much higher assessment. So let's go back, and we're gonna compute in Richmond, Virginia. It's $1.2 on every 100. So 1.2 million times 0.012. This is gonna be my annual property taxes. So now I can go in here and adjust this. There you go. So my after repair value is going to be roughly $1.3 million. So now they are currently asking $995,000 for this building. So the question is, if I buy it for $995,000 and it's going to be worth 1.3 million, how much is it going to cost me to renovate this? This is our next step in our analysis. I hope you're following me. If not, go back and rewatch it, right? This is where we're at so far. They're asking $995,000. Based on the projections that I'm making, the building, after the renovations are done, is going to be worth 1.3 million. This is the income that it's going to be producing on a monthly basis. But what I don't have here yet are two things: what the renovations are going to cost me and what my short-term financing is going to cost me. So we're going to do that next. So let's go in here and pull up a budget. Let's go to detailed input and let's just make a quick budget. So I'm gonna ignore my soft costs for now. I just want to get roughly in the ballpark. So I know that first of all, what I'm going to do is I'm going to fill in number of units here, and you'll see why this is important soon. So number of units is 8. So I know that we're going to need to upgrade the HVAC system because we need central air. So I'm just going to call this improvements, and let's say upgrade to central air, and I'm going to click my drop down, select number of units, and I'm going to say it's going to cost me roughly $5,000 per unit. And you can see my budget is automatically shown as $40,000. I'm going to click add, and the other thing, I don't have the pictures and I haven't seen the property yet, but I can guarantee you that the bathrooms are outdated. So there is one bathroom per apartment, and it's going to cost me roughly, and again, I'm just ballparking here, but it's going to cost me about $3,000 to fully update these bathrooms and make them really nice. replumb them, replace the tubs, replace the flooring, replace the vanities. I'm probably going to have to redo some of the drywall, etc., etc. Then I'm going to update the kitchens. Again, number of units. And it's going to cost me, including new cabinets, including demo, including new flooring, new cabinets, new granite, it's going to cost me about, I'm just going to ballpark at $5,000 per kitchen. These are not big kitchens, right? So what else in the building needs work? I don't know the condition of the roof. I don't know the condition of the masonry, though it looks pretty good. I'm going to guess that plumbing and electrical is in good shape, but there's still a lot of unknowns, right? I'm probably going to want to refinish the hardwood floors, repaint, etc., etc. So for now, because I want to do a quick analysis here, right? I just want to determine whether the price that they're asking is even reasonable. Other updates, I'm going to ballpark at roughly $10,000 per unit. So this gives me a rough budget of $184,000, and what I'm probably going to do is I'm going to add a contingency here to round this off to $200,000. And so what I'm going to do is, if I decide to go look at the property, I'm going to take obviously better notes and put together a better estimate. But for now, this is what I need. $200,000 in renovations. So now what do we know? We know that if I pay what they're asking, and I'm going to put another $200,000 into it, with my renovation taking 4 months, and the other thing that I haven't taken into account yet is how long the existing tenants are still going to be in there before I can kick them out, right? But if it takes me 6 months to renovate and lease up, I'm going to be into it for $1.2 million, which is 92% of after repair value. That's not that great. And my cash on cash return, if I buy this whole deal with cash, is going to be 7%. So what I need to do now is model my financing. What is my short-term financing going to cost me? I'm going to assume that I can go to a local bank and get 85% financing that will cover both purchase and rehab. I'm going to pay a point, and I'm going to pay roughly, right now, let's say 5.5% interest. Right, very simple. 85% of cost, 5.5% interest rate. So look what that does. That raises my cost basis to 95% of what the property will be worth. There's no profit to be made here. So what I'm going to do now is I'm going to go down and adjust my purchase price in order to be at 80%. I want 80% sweat equity. So I'm going to go down here and adjust it down to $800,000. I have to pay $800,000 for this building, put another $200,000 into it, and then after all my holding and closing costs and financing costs, my cost basis will be 80% of the project. So now, assuming I can pay $800,000, right? Let's look at the project summary so this will make sense to you. This is what the deal would look like. I pay $800,000. I put another $200,000 into it. I need to go back and adjust my closing costs because they're going to be higher. So let's go back and let's adjust my closing costs. And let's say they're going to be roughly 2% of my total purchase price. So this is what the deal looks like. I buy for $800,000. I rehab for $200,000. These are my total closing and holding costs. This is what my financing will cost me for 6 months. This is my total project cost basis. This is how much cash I would have to bring to the deal for my short-term financing. This is what the property will be worth after the renovations are complete. This is what my equity would be on paper. And if I leave, now the issue is I have to refi out of this financing. So that's the last piece of analysis, right? Because short-term financing is interest only. It's only good for the period of time that it's going to take me to renovate and lease it. right? So this is not permanent financing. So the last missing piece of the puzzle is I need to refi out of this into permanent financing. So I'm going to go here and I'm going to select yes. And I'm going to say I can refi for 80% of the new appraisal. So I can refi out for 80%. And this is how we complete our BRRRR analysis. I can refi out for 80% of this new appraisal. And I'm going to pay 5.5% rate, amortized over 20 years. And I'm going to pay a point on my refi. So this is my new mortgage payment. This is my new refi loan amount. And if I do this, here's what happens. I was into this deal. My original loan was $867,000. My new loan is $140,000. Now that's pretty good because it lets me pull out almost my entire cash into the deal. But here's the problem. If I do that, my new loan is too high because my cash flow goes negative. Are you following this? So if I refi out for 80% of the new appraisal, the new loan is too high. The property can't support this loan. My debt coverage ratio will be less than 1. So what I need to do now is I need to adjust this percentage down to where my debt coverage ratio will be 1.3 or higher. That's how I know that I can actually get this new loan. So if I go down to 60%, boom, my debt coverage on my new loan becomes 1.3. That means the bank will actually give me this loan of 60%. So what does that mean? That means I can only get a loan of 60% of the new value. So the new loan will be $780,000. But my original construction loan was $867,000. So if I do this, that means I would have to bring cash to the table in order to refi. Are you following this? If you truly want to learn what I'm doing here, because this is incredibly important, if you truly want to learn this, then I highly recommend you replicate what I'm doing here in your own software account. Look, this is how much cash I would have to bring to the table at refi. And then with my new loan amount, my cash flow would only be about $200 a unit. And on the $277,000 that I leave in the deal, I would only be generating a 7% cash on cash return. Do you see how there's multiple levels to this analysis? If we didn't do the refi analysis, we would say, well, we're going to create 20% sweat equity. That's great. Let's offer them $800,000. But the problem is, I'm going to leave too much money in this deal. I can't pull my cash out. So I wouldn't even offer them $800,000 because my permanent financing is majorly unattractive. I hope you're following me, because if you can learn how to do this analysis, it's going to save you from countless bad deals. So what do we need to do? I certainly don't want to be in a situation where I commit $180,000 to my construction loan and then have to bring another $95,000 to the table when I refi. That's not great. So my only option is to pay less for the deal. Let's try $700,000. Now the problem is, in this market, they're not going to take $700,000. Somebody's going to go in there and overpay. But look, if I pay $700,000 and I refi out at 20% of appraisal, that means that I only need to bring to the closing table at the refi $8,000. My cash flow is about $200 a unit. I'm leaving $172,000 tied up in the deal, but I'm generating 11.2% on that money on an annual basis. This is where this deal would meet my investment criteria. Right? Let's recap. Let's look at project summary and let's look at marketing sheet hold. Project summary is available in the free version. The rest of the reports are available in the premium. So this is what the deal would look like. $700,000 purchase price. I put $200,000 in. My total cost basis is this. On my construction loan, I commit $164,000 in cash to the deal, and my bank finances $780,000. These are my new loan assumptions. $1.3 million appraisal, $780,000 new loan, which is almost the same as my construction loan, but I have some closing costs to pay, so I have to basically bring this in cash, right? So I bring $8,300 in cash to the closing table at refi. I have $172,000 tied up in a deal in cash. This is how much equity I have on paper, right? So $520,000 is a combination of the cash that I have into the deal and the sweat equity that I've created. This is my monthly cash flow, about $200 a unit, which is, it's okay. And then I'm generating 11.2% cash on cash return year one on that money. So this is what I would send to my construction lender. This is literally what we send to them in order to get financing. I show my bank, this is what the property will be worth. This is what I intend to purchase, or this is what I have it under contract at. This is what I'm going to put into the deal. This is my cost basis. This is the projected net operating income when I'm done. It's going to take me 6 months. I'm going to refi out of your construction loan, or I could send this to my takeout lender, to my permanent financing lender. This is the takeout loan. 1.3 debt coverage on the new permanent financing, assuming 5.5% and 20-year AM. Now here's the other thing I could do. For an 8-unit apartment building, I could go to one of my local banks, and instead of 20-year amortization, I could go to 25-year amortization. That changes things significantly in terms of my cash flow. Look at that, my cash flow goes up to $2,200 a month, and that's a 15% cash on cash return. And look what happens to my debt coverage. So if I can get a 25-year AM loan, I can get a higher, potentially a loan amount. So let's go from 60 to 65, maybe 67. So I can actually get a refi loan amount of $871,000, which means that I actually get some cash back at closing. So I had to put $164,000 into my construction loan, but at refi I'm going to get $81,000 of that back. So I'm only leaving $82,000 tied up in a deal, and I'm generating almost 24% return on that money. Now that's pretty good. Will that allow me to pay more for the deal if I have to? Yes, but I wouldn't want to, right? This is an attractive deal. Let's recap again. Look, nobody teaches this stuff, right? I'm not showing you how to make $5,000 wholesaling tomorrow from your computer, right? That's what everybody else wants to show you. This is, if you take the time to understand these numbers, you're going to be far ahead than 97% of all investors in your market. So let's recap, right? At refi, I actually get $82,000 of my cash back. My cash flow doesn't change, right? It's still about $1,600 a month, but I'm generating a much higher return on my cash. Now, if I have to pay more for the deal, I can go back here, and now, assuming I can get 25-year takeout financing, let's go back to $800,000. What happens then? Well, that doesn't change my permanent financing, but that means I'm not getting any cash back at closing, right? I actually have to I'm back to having to bring some cash to the table. My cash flow doesn't change. I'm leaving $187,000 tied up in the deal, but it's still a 10% return on my money. So look, if I have to go in and pay $800,000 for this deal, I can. Now, again, the problem is in this market, so, because it's in a great location, somebody's going to come in there and overpay. But if I have to, I can pay $800,000 for this deal, and this is what it would look like. This is purchase and rehab assumptions, and these are my projected results for after the property is renovated. And obviously, if you're watching this, there's a ton of additional functionality here in the software, right? I've got my project management tools here, my ability to actually start storing bids, storing all my bid documents, tracking the project in real time. There's a full presentation suite in order to raise money for this deal, for short-term and permanent financing, etc., etc. But I wanted to make sure you understand this analysis. It's incredibly important because this is the only way I can be sure that I can actually afford to pay $800,000, because I've actually seen what this deal will look like all the way to the end. All right, so let's recap really quick before I let you go. All right. This is how you do this analysis. Start at the end. Determine your after repair value first. Know where you're going to end up before you figure out what to offer, right? So you project out your new income and operating expenses to compute your net operating income. And then you apply a market cap rate to back into your after repair value, just like I showed you, right? So if apartment buildings that are newly renovated in your market are trading at 6.5 cap rate, then just apply that same cap rate to your new net operating income, and that's going to determine your projected after repair value. Then back out your projected repairs, back out your projected closing and holding costs, and the cost of your short-term financing, and that's going to help you determine your max offer based on how much equity you want to create. But then after you figure out your max offer based on your equity, you then have to make sure that if you pay that price, A, your cash flow is going to be sufficient, right? And then what does your refi look like? Can you pull out enough cash to make it acceptable for yourself? And will your cash and cash return meet your threshold, right? And if it doesn't, then adjust your purchase price up and down from there. But you've got to do this full analysis for a deal like this before you can figure out what you can truly afford to pay for it. You've got to take this deal from start all the way to finish and look at every factor. And that's what I tried to show you in this tutorial / case study / whatever you want to call it. All right. So if you have questions, post them below this video. I'm going to answer every comment and every question. And if something in this video is not clear, ask it below and I will answer it. All right. Now, what you should do next. Again, leave me your comments, feedback, questions below. If you already have rehab value to premium, put what I showed you to work. A lot of the analysis you can do with the free version of the software, the detailed budgets, the project management, the marketing, funding presentations, all of that comes with the premium version, right? So if you don't have the premium version yet, sign up here, rehabvalue.com/upgrade. You can get the full project management functionality, full reporting ability, big bonus package of real estate education, and go to rehabvalue.com/developers because I have much more detailed BRRRR training there, as well as training on ground up construction and commercial development. So that's it. All right. Thanks for watching. See you soon.